To introduce my next guest, who really does not need an introduction. He's had more than 30 years' experience as an entrepreneur, investor, and corporate advisor in New York, London, and Sydney. In 2000, he co-founded a leading Australian boutique corporate advisory and private equity firm called Carnegie, Wiley & Co. Currently, he's the founding partner of MH Carnegie & Co., managing funds in excess of $900 million, with a successful track record since its establishment in 2011. Ladies and gentlemen, please put your hands together for Mark Carnegie. Okay, so just a note on this session, it's a little bit different to the previous one. We're going to run it as predominantly a one-on-one interview between Mark and myself. But as usual, I have the iPad and I'm going to be taking as many audience questions as possible. You might have noticed with the first plenary session, time does seem to fly. So if you've got questions, I urge you to use the app, but also feel free to put up your hands and I'll try and get to as many questions as possible. Very good afternoon to you, Mark. Lovely to be with you.
Thank you very much for having me.
So we've just had the last session of the Banking Royal Commission looking specifically at super. Some pretty interesting findings. What's your take on it?
Well, I think basically it's a tide turn. If you think about your industry, really since Gary and Kelty and Keating started it, the banks have tried to take share away from the industry super funds. My guess is you've got a situation where it's not mandated, but it's effectively the case that the outcome of the Royal Commission has said that they want 30% of lending to be done by the people in this room rather than the banks. And everything I see in terms of APRA and the RBA and everyone else intervening in the market feels like it's a gigantic opportunity for you. Now, I'm glad I didn't have a speech ready because I would have had to torch it because Gary said everything in the first session I was going to say, and he said it, as always, way better than I was going to as well. But in terms of number one opportunity about where can you guys put money, you've got a situation where the banks are absolutely scared witless as a consequence of the RBA. They're not going to be able to lend on a rational human being basis from now until kingdom come. And you guys are in a position to be able to go and do that, where for the first time, at least in my career, the Aussie 10-year is trading, at a lower interest rate than the US 10-year. And so your whole reference rate and your ability to go and earn a good return for your members actually moving into the space which the banks are moving out of creates a great opportunity for you.
So in addition to, of course, the tightening of lending restrictions on the banks, one of the things to come out of the Banking Royal Commission, particularly in this last round which focused on super, was industry super came out looking remarkably good, especially in light of some of the revelations not only around banking, but even if you look specifically at retail super funds. Clearly there is an opportunity here, is there not, to capitalise on this?
I think so, and I think the big question is, I don't know how many of you followed Jack Bogle and Vanguard and what he was saying, but he ended up with a mutual organisation to compete against the for-profit fund managers in the US, and with none of the sort of tailwinds that you guys had in Australia, he still absolutely knocked the cover off it over a long period of time. To me, all that's happened here is that the fundamentals, which are incentive bias in the banking system and the for-profit money management businesses, meant that 60 basis points of the 80 basis points is to do with fee gouge, and then, as Gary was saying as well, there's probably 500 basis points of surplus return by being willing to invest in long-term liquids over a long period of time. That explains why you guys have been able to do, over a long period of time, so much better than them. And as you say, Del, it's only going to get better. Sound like Tony Blair.
Looking... Sorry, what did you say? I totally missed that.
No, I said it's like Tony Blair's theme song.
In terms of the super industry, retail super funds came under quite a bit of fire. Some terrible findings that came out as a result of it. Former Prime Minister Paul Keating has come out with somewhat of a radical suggestion that you should just remove the ability for retail funds to make a profit. What are your thoughts on that?
Well, I mean, I think, Keating, who was, by the way, my chairman for a lot of years, so I have an immense amount of respect for him, but I also have an immense amount of respect for his ability to get a headline, and that was a good one. I think he's on the right point. I think his prescription is wrong. Ultimately, my argument is that, very early on, for anybody who did a law degree or anything like a law degree, the first thing you learnt in your trust class was Rule 1, Day 1, as a trustee, don't let your interests and your duties conflict, yeah? And we don't need, we're going to have a whole lot more 27 committees bullshit regulation as a consequence of the Royal Commission. We all know that. To me, how much that actually works compared to just create another industry of bullshit, I don't know. In contrast, 500 years of don't let your interests and your duties conflict, I think they were pretty smart back then. So that'd be my point number one, which is you created an industry where feeing your clients to death was what got you promoted and got you paid. That has to end badly. And they basically lifted up the rock and now everyone's seen the cockroaches. But
so do you think they should remove fees?
So?
Do you think it should just...
No, I'll get to that. So let me get the punchline.
Sorry. Go on.
So my hero is Charlie Munger, Warren Buffett's partner, and his comment is, I believe in the power of incentives more than 99% of the people in the world, and I'm 93 years old, and yet every year it dumbfounds me how powerful incentives are. So Paul's broad brush, just ban them, doesn't work for me. I think reinstituting something that says we really need to do something about the fact that your financial incentives cannot cut against the interest of a whole series of uninformed people. So to me, it's a back to the future, get back to the obligations around what a trustee fundamentally has to do, which is act in the best interest of the clients, not in the best interest of the for-profit company that owns it.
A question here from Graham Russell. Thanks, Graham. He says, aren't we missing the real question? How is it that hundreds of people in AMP, CBA saw such wrongdoing and said nothing about it? That's the great worry.
So ultimately, that's the existential question I'm trying to ask at the moment. Not so much, I have to say, about the Royal Commission, because I think what was happening there is, not just another dimension of what happened with all CLOs and CDOs and the, great financial crisis. What's happened is you've got a monster amount of regulatory capture here where the financial services industry has captured the economy. Essentially, the financial services industry was meant to be a servant of the economy, the society, yeah? And over a long period of time, and you can look at the market cap of the Australian banks as a percent of GDP compared to anywhere else in the world, for whatever reasons, probably because they dodged a bullet after the 87-92 problem, they're in a position where they just controlled the economy. And then the second thing was, Swan had not a lot of time, yeah, when it was that weekend and he had to give the guarantee to the Australian financial services crisis. But looked at in any perspective, given how close, clearly one of the regional banks was going to go that week and then the ANZ was going next because all of those converting preference shares. And if I'm going off at a tangent, you can stop me.
Yeah.
It was clearly a problem. And the deal you would have done if you were a greedy capitalist running dog like me was, guess what? Half your business forever or you're toast. And then you had a horrible thing if you were one of those banks because you didn't take that trade and everybody else did. You were all over and gone. And you would have seen the run where ANZ would have got toasted and the other three would have been okay. But he didn't have that time, etc. And a lot of what's going on now is as a consequence of that and the fact that everybody said we didn't need the help. And I don't know whether you watched that weekend where all of those converting preference shares that were sitting in the UK market were trading at like 1,200 over or something like that. You knew it was going to pop. So I think that's ultimately the question, which is for whatever reasons, the banks have said they don't need the guarantee. And this is where I'm back to Keating. If Keating had been there, not Swan, he would have owned their ass and things would be very, very different.
So then the question is, should the banks be liable for lost super earnings of their members?
I think by the end you saw that.
Super returns?
Yeah, you saw that mis-selling of the 35 million that Westpac paid. I'm sure there's a couple of $100 million, maybe there's $1 billion in sort of payments by the banks. But what's that? A parking ticket when you look at their aggregate profits? So I think there's going to be something, there's going to be a headline, but is there going to be any structural solution in that way? I can't see it at the moment.
Okay. Keep in mind, I'm taking your questions via the app, but if you've got a question and you would like to ask it via microphone, I'm looking to the audience, so just pop your hand up and we'll get a microphone to you. Earlier we were talking with Gary about collaboration, particularly between super funds and industry. You're a venture capitalist. Mm-hmm. Could you see a collaboration between venture capitalists and industry funds?
Well, I think there's two different things. I think there's always collaborations between industry super funds and funds managers in all sorts of ways, and I'd just say also, as somebody who's on the other side of this whole fee debate and the fact that Australian superannuation funds pay less fees in aggregate than people in the rest of the world, I'm one of the people who tells you, good on you, you're doing a great thing, which is, to have the fees at half the rest of the world, in the end, you're doing God's work to stop what's happening in the US. So anybody who says, no, you can't hire the best people on half of market rates, given the scale economies of the fund management business, they're lying to you. And you know how many of those guys who are managing multiple billions of public equities and really shadow indexing with 80% of their portfolio are just making off like bandits. So,
but then on that note, what would be some of the impediments to superannuation?
Sorry, lost my thread. So collaboration between us and you, the fact that you continue to pound on people about fees, good on you for doing it. The big question is not that. The big question is the one that Gary was asking. What was it that meant that you had, at a particular early stage, an ability to overcome the collective action problem on infrastructure and work together? And what is it on the list on, forget the agriculture, because like him, I can't see how risk-adjusted that's a category that you can invest in scale. But the other ones, it's really all of your incentives now are 50 basis points for 3, 6 and 12 months outperformance, and you're at the top of the league table. That's what's going to make you feel good at whichever club or conference you go to. But we all know that really the thing that matters for your members is you guys getting together in the way that you did and be the global market leaders in infrastructure investing. You've got to find some way to do it for the other things on Gary's list. So it's not collaboration between me and them. That part's working just fine. It's how do you guys deal with what I call a whole of society profit opportunity where the banks are out, you guys are in. Now, I think the original IFM model worked really, really well in the early days, and Gary won't say it to you, but my guess is the problem is everybody now wants to do their own thing. All the industry, everyone's hiring their own teams. That ain't an easy way to get collaboration because everybody's now on a relative performance game rather than a total performance game. And so I'll just take an example, simple one. Everyone knows that early intervention in education for underprivileged people improves the individual outcome for that person who's from a disadvantaged home. Everyone knows it. And it means that 10 and 20 years out, the society doesn't have to pay any sort of social security or any other sorts of problems, and they get a taxpayer, and so they get the revenues back. Everyone knows it. The numbers are there all the time. It's a solid, low double-digit, on a historical basis, maybe high single-digit return for the society at the moment. But the question is, who's putting the money in and how to actually get that return? So now we get the problem of state governments want headlines, federal government wants headlines. How do you actually get something where the return is clearly there for the society, and people won Nobel Prizes as a consequence of actually getting to the bottom of how those numbers are? We've got capital that you would deploy in a heartbeat for an 8, 9 or 10% 20-year return in education. The answer is you're not asking the government to do anything other than find some way to give you policy settings that let you take advantage of an opportunity that's glaring. So too the aged care one, or the glide path to stop people, this whole thing which is at the end of your career, what you really want to do is sort of find a glide path from full-time work to part-time work. The society wants the glide path to be as slow as it can as well. And you've got a whole lot of broken things there. The third one is half the people in the room, or maybe it's a third because it's gendered, know the problem about the on-ramp where you get, women get taxed, including childcare, at somewhere between 85 and 90% to come back into the workforce. Yeah? I mean, the numbers are absolutely mental. So you've got a whole lot of really, really valuable contributors in the society, and we're sitting there and taxing them like they're some 1960s plutocrat.
Yeah. Look, I hate to take you off that tangent because I do love it, but I'm going to just try and get to some audience questions. One question here, Mark, the banks are selling their asset management businesses except BT. Will BT benefit from their position, or will they be pressured to exit as well?
I've never been able to figure out what's going to happen there, right? So there was times where that was absolutely would have loved to buy that business. Like the money management business has such great economics where, in my capacity as capitalist running dog, I'm always trying to buy those things. But right at the moment, I'm just not sure that it isn't an existential moment. I don't think in the end they're going to own it, is the truth. I think this guy maybe, but the next guy's going to say, no, it's now fashionable to have sold my boat, so I'm going to sell my boat at the moment. But I don't see it as being a long-term thing. And I don't think on a relative basis they're going to perform, because I think just the brand damage to the banks in the superannuation area is just too large.
So on that, if you were appointed to rebuild trust for these companies, for example, AMP, what would you do? Will it come at a shareholder's cost?
So just, the numbers on Gary's slide will really get the answer, but I'm going to do it my way.
Just go for it. You don't get a presentation. I'm letting you get away with it. Go.
Those numbers are big on the screen, but Amazon went through $1 trillion US of market cap at the moment. Yeah. The thing I'd say to you is technology is handing so much power to the attacker, and the inbuilt problems of existing platforms and IT are creating so many problems playing the defender hand, that I think a lot of these things are going to be extinct. I don't know how many people in the room ever go and see the rounding error you've got in venture capital, but I share offices with Daniel Petrie and Craig Blair. The tech IT and what you can do from a standing start at the moment is absolutely enormous. So I was hearing the story about hiring some guy from, the latest, greatest hedge fund guy from Asia and bringing him back to run AMP's funds management business. AMP ain't a funds management business. It's a tech platform and a sales agency. And I'm just not sure it's actually going to be the way that anybody of Gen Y buys their super.
Yeah. It is rapidly changing, and I know you said in a Four Corners report that the superannuation industry that was designed years ago is perhaps not up to date with the next generation or the younger generation, which is something I want to get to. But I do have a question here from Brett. He said there was an AFR article about the rise of CLOs. What do you watch out for as a potential trigger for next correction, recession, crash?
So two different things, which is Buffett's, sorry, keep on quoting the people everybody like me does. Buffett's got this line, which is there's nothing so dangerous as in investing as a good idea taken to extremes. The original CLOs were a fantastic idea, right? And there's a whole lot of them getting put together at the moment that we're investing in with our ears pinned back because the banks are basically pulling out of the small business lending market, and you're able to lend to people who are absolutely jammed that are great credits at 1,000 over, but you've got this problem where you need a portfolio of the things because single, you can't do it anywhere else. So I like CLOs at the beginning of the cycle. Then the whole question about where's risk in the financial system, I feel like risk is in the financial system is the fact that we've got a guy who's, created a structural deficit in the US, and we have a 2.8 to 2.9% US 10-year interest rate and a 2.6 in Australia. I don't think the problems are going to be buried where they were the last time. I think just get one of your economists in one of your businesses or somebody else to run how the world looks like with an 8% reference rate, not a 2.5% interest rate, if you want to see how the world's going to blow up.
What is your investment philosophy?
My investment philosophy for what I do, as opposed to the people in this room, is, hey, money is a commodity. I'm the high-cost producer of a commodity or provider of a commodity. That is a shitty business. If you're a high end of the cost curve for a commodity, it's bad. There are only two ways to solve my investment philosophy. One is go to a place of local scarcity, that is where the money ain't, and invest there. And the second way is take your commodity and manufacture it into something else, a solution that somebody else can't provide. That's what I do, right? And then for the people in this room, instead of it, which is, I'd have two comments, which is beware the 10-year, yeah? Because if you go back to 87, it looked a lot like the first quarter of this year, not like other times where you just saw the 10-year start marching up and up and up, and the equity markets kept on marching up and up as well. And there was just a point where there was going to be mean reversion and something was going to snap back. Now, what do we get, 316 or something like that before it's come down again? But could be that again. So that'd be the first thing, which is ultimately everything's going to hang off the US 10-year. And with that guy spending like a drunken sailor, it's going to happen at some stage.
Question from the audience. What do you make of, or what do you think the impact of generic benchmarks that are currently being adopted by the super industry? Are these benchmarks decreasing innovation, innovative investment, and potentially risk-taking?
Ultimately, the problem, I don't have any problem with the benchmarks because I think like the industry super or like Vanguard, indexing in the end is a fantastic thing. Fees are the only certainty. They get taken off the top, all of those things. But I think the big question I've always had, and maybe somebody in the room knows better than me, we started with a sort of 6% equity risk premium when, what do we have, a 12% Aussie 10-year and a 8.5 US, and you sort of got it, which is, it was a 30 or 40%, you earned 30 or 40% more for being in equities rather than debt over a long period of time. Down where we are at 2.5% to 3%, the idea that somehow you're going to be able to earn 3 times out of equities what you earned out of bonds as a benchmark seems to me to be just nuts. Whereas if you said, I want to earn 50% more in equities than I do in bonds, that sounds about right. So I think everything that looks at a sort of 10-year forward, how much are you going to earn out of your overall portfolio, I just think, and this is way bigger problem in the US in terms of defined benefits rather than defined contributions. But I just think people who are sitting there and thinking they're going to earn 6% real, they are smoking something I want a ton of.
A lot of people in our audience are keen to get your insights onto, in terms of long-term investment themes and ideas. What are they? Where should the industry be looking at for the next 10 years to be able to engage their members re-super?
Go back to Gary's first slide and basically put the the TIPEX over ag. I mean,
You think agriculture?
I think not agriculture, the other ones, which is
construction. Yep.
The global pool of infrastructure opportunities and the societal return for those are huge. Is there a better place to invest? Perhaps in education and ageing. Yeah? And then the other ones, so if you're looking from my perspective, do I like bonds where they are at the moment? No. Do I like global equities with perhaps the exception of emerging markets where I feel like, the retrace means there's some value in that? And I think this whole trade war is about a headline rather than the fact that we're going to unpick the world trading system. I just can't see that, but I could be wrong. So emerging market equities, if you want a straightforward one. Infrastructure for sure. The early intervention and the aged care stuff seems really good. But the biggest idea is, my guess is there is 50% more per capita GDP available to Australians if we can find some way to overcome these collective action problems. And in the end, I know everyone in the room cares about being 50 basis points ahead of everybody else at the end of 10 years because it's going to make them feel proud. But the truth is, we can end up with our kids having an infinitely better life if we can act together to make the social latency that we know is available because of these breakages we have at the moment solved by the fact that the Keating-Kelty superannuation industry put a huge amount of the pulse of productivity that came from deregulation into the hands of all working Australians. And to me, that's the great opportunity. We can make our society a lot better and earn great returns for Australians by using the fact that we are all capitalists as a result of superannuation in Australia.
A topic you touched on a little bit earlier was the next generation and their way of dealing with super and their approach to super. So this question from the audience. Hi, Mark. The technology opportunities are being taken up by SMSF providers. Will this result in millennials buying their super from SMSFs rather than APRA funds?
I just think you look at the maths of, maybe Gary or Greg or somebody in the room knows, but is break even $500,000 for an SMSF in terms of you need $500,000 in your SMSF to make it work on a fee basis? And that sounds to me...
How much? Billion?
A million?
Million.
Yeah, so the answer is, could you get them to do it? Yeah. Is it absolutely nuts for them to do it? It's crazy. It's another type of fee. So what I call the intergenerational Marxism, which is the old people are the capitalists and they've also got the levers of control of power, witness that we're going to kill the idea of retirement in 70, right? That's our problem, which is, they're left with debt from tertiary education, which they have to do because the world means without tertiary education, you're screwed at the moment. So you start out with debt slavery before you start it. You've got this situation where on any sort of mean reversion basis, rates have gone from double digits to low single digits, so you're going to have shitty investment returns. on an aggregate basis before you start for the young people. And then essentially NIMBYism and no long-term planning on infrastructure means that entry-level housing's unaffordable at the moment. It's just, you know, the whole point about why I got invited here, we have given our kids an unbelievably shitty deal. And then the second thing is, everyone in this room, it's all fine, because whether it's grandparents or us or how much you're going to give them or something like that, but the truth is we're all going to give our kids a deposit or more, right, to get into the housing market. We're going to find some way to help them. But what it's doing on a sort of second iteration, unfairness allocation, where the kids from underprivileged houses are getting an infinitely shittier deal over the next 20 years because my kids are going to get, you know, grandparents' money, some of my money. They're sitting absolutely pretty. All of the stuff about education, they've had tutoring and all of those other works, whereas the people who worked like hell out west in the previous generation and bought a house for not a lot of money, got a Commonwealth government scholarship or something like that. We have this intergenerational inequality time bomb just sitting there waiting to blow up.
That's a pretty depressing and bleak future. How do you change it? What do you do? What's the solution?
Well, I think the first thing at the moment, so my first solution is reduce the voting age.
Reduce the voting age?
Yeah, to 16. Because you look at Brexit.
Sure?
Yeah, absolutely. Absolutely. Because the truth of the matter is, in a whole lot of the marginal seats, the old people, because they vote, you know, Tory and stuff like that, in the end, they've got control of a whole series of the levers of power at the moment. And Brexit's the best example of this, which is, hold on, people are going to be dying next year before Brexit even happens, basically sold their kids out of Brexit as a result of some fucking sepia-tinted bullshit about the 50s.
But Brexit happened because enough young people didn't vote.
I understand, but we've got compulsory voting here, thank the Lord. And the second thing is, if you put more young people into the system, perhaps the whole get-up and disengagement gets going a bit more, and it tilts it towards the people where policy is actually going to matter for them.
All right, Mark, we have well and truly gone off on a tangent. I'm going to bring it back.
You asked me.
Sorry. Michael Colo, thank you for your question. What do you think about the impact of AI on the future of jobs, retirement, and the idea of a universal income replacing super?
Well, it's not going to replace super because UBI is trying to solve a different thing. What I've said about the UBI, which is one of... So we'll be off at a tangent again and you'll have to pull me back. My view about the UBI is the following, which is what people need to understand is we have 3 failed states in Australia. People don't want to admit it. Tasmania, South Australia and the Northern Territory are essentially a basket case. And spending $28 billion on the submarines, right, for a couple of marginal seats and placating a couple of senators was an act of total and utter insanity. What I proposed was test a UBI in Tasmania or South Australia and see if it works or not. The time that I was suggesting testing the UBI, the Finns were doing it. They backed off because it didn't work. But there's some good stuff out of Nigeria and the UK that says it is. So my view is you can't just introduce it, but we've got broken states in Australia and we've got a broken constitution where we placate them. Let's try the UBI. So that's the first one. The second one on AI, it's on a long-term basis, AI can only be good. More productivity, a better society. On a short-term basis, could it create just hell's own trouble because a whole lot of what David Graeber is calling these bullshit jobs get eliminated? Absolutely. And I got the Grattan to run some sort of numbers on at what point, if this pulse of unemployment comes as a result of AI, does the UBI actually become a thing? And it's probably 11 or 12 or 13% unemployment. At that point, the UBI saves you money rather than costing you money. Everybody's like, it ain't going to happen. And the Grattan says we're getting nothing that shows us anything in terms of AI wiping out jobs at the moment. But if you see that unemployment number start to tick up into the high single digits, which is not inconceivable, I think you probably do tie the two together.
Okay, if there are any audience questions, you can put your hand up, but thank you for everyone who's sending them in. David Hartley is asking, super funds have been in the last decade or so very collaborative. Has this choice been positive or negative for
the
Australia?
first pass, David.
Super funds have, in the last decade, been very collaborative. Is this a positive or negative for Australian workers?
I think it's been absolutely... I will not take the cheap shot about how the Catholic Church seems to be unable to be collaborative, but somebody got to laugh. But I think it's been hugely positive. I mean, look at IFM's returns in terms of those collaborative infrastructure investments and a single check solution to that. I think fantastic. And what I'd be saying is the members, ME Bank and those sorts of things, $1 billion capital raise to go out there and do that again. Do I think that's going to be societally productive where we are at the moment? For sure. Go ahead, David.
Yeah, no, the question was, choice of funds so the government brought in choice of funds.
Right. Has the choice of funds been positive or negative?
Yes.
Sorry, do you want to add to that?
Yeah. So choice of fund legislation, when the government brought it in, was to be, have competition, that sort of stuff. I think super funds going back used to be very collaborative. I mean, in fact, that's where you got IFM from, right? So collaboration. And when I first joined Sun Super, that was very, very strong feature of industry funds. They did team together with a whole lot of stuff, and they hardly ever advertised. But then choice of funds came in, and of course what you've had now is everyone's have to go out there and advertise. They've got to compete with everyone else, and so has that been negative or positive for workers?
Good question.
I think net positive, with caveats about, does the marketing overall help, etc. I think engagement, profile, stuff like that is fine. The whole question, I haven't seen in the industry funds as opposed to the for-profit funds, hugely insane numbers compared to the US in terms of marketing spend. So my view would be net positive, but I can understand how people say, well, why should you possibly advertise what you're doing compared to anybody else? And maybe there's a code of conduct around that you want to introduce, given what you're trying to collectively take share away from the banks. I don't know.
Can the next generation inflate their way to financial equality?
When they've got no money, the problem about it is I can't see how that's going to work, which is, I get how the 86-year-old punter on the unmortgaged house sits pretty, if we go through some sort of 30s style hyperinflation, but I'm struggling to see how that's going to help a 26-year-old kid who's just come out with a first-class honours degree from, in economics from Sydney Uni.
So then another question on that, will younger members then want EFTs instead of super?
Well, I think EFTs is just one of the assets in a super fund, and I think it's a good one, and I think that's the reason why it's gaining share.
And it's also, I think, would younger people know enough about super to be able to make those type of choices? Because I think that's where there is a big gap, isn't there?
Yeah, but I mean, I think this goes back to this question about should you rattles around and it never happens. But this whole question about should there be some amount of fundamental, compulsory secondary education on budgeting and planning and money and stuff like that. The truth is, compared to a whole lot of the other crap that they have to learn in terms of gender diversity and all of that other stuff, 1 or 2 months of basic budgeting would strike me as being a pretty sensible life tool for these kids.
Question from Greg Clerk. Capital fights dirty and politicians are cheap. So why can't incumbents stymie progress for an extended time, i.e. red flag laws, climate mitigation, etc.?
Say it again.
Capital fights dirty and politicians are cheap.
Yep.
So why can't incumbents stymie progress for an extended time, i.e. red flag laws, climate mitigation, etc.?
They did. For $50 million, they stopped the mining tax, right? So, absolutely. But on the banking side, capitalism lost one, and the democracy won one. And the thing is, ultimately, the democracy is more powerful than regulatory capture. So, to me, is it, 60-40 winning the tactical battles? Yes. But I'm a believer in long-term capitalism for a whole series of reasons is the best system that works. And the second thing is, I do believe in our democracy. I've got doubts about the Senate for South Australia and Tasmania, but overall, I think we've got a really, really good functioning democracy, and I think the power in the hands of the democracy is more than the power in the hands of all the people who are setting out to fight dirty in capital.
Mm-hmm. We've got just over 5 minutes with Mark, so if you've got any questions, now's your time to send them through. There's a question over there. I'll get to you in just 1 minute. Trust has taken a massive beating as a result in financial services across the board as a result of the Banking Royal Commission and the findings. How can funds rebuild that, particularly in financial services, build greater trust?
But I'd go back to your point, which is you guys basically got a hall pass.
A certain part of the super industry did, yes, industry funds more than retail funds.
Yeah, and so I think,
And we're still waiting for the recommendation. So, I mean, yes, absolutely, relative to everything else.
So the banks have one of the most unbelievable industry structures anywhere in the world. Yeah? And compared to just all sorts of other places in the world. So I'm not sitting there and thinking, oh my God, as a consequence of this, anything, even if they end up with 50 parking tickets, it's going to be a rounding error to them, right? And so some board members have to fall on their sword and the normal bullshit, but they're going to march on just fine with 75% market share rather than 99% market share. So I don't see anything that's sort of structurally going to existentially hurt them. And then this whole question about trust. I go back to my original point, which is there is a mismatch between what you should be doing, which is looking after your client's interests, and the industry structure. Yeah? And unless you find some way where you say, we're going to do something different to that, there will be periodic times where this happens. Now, the truth was we lasted a long, long time since the 87, 92 Farrago, and we did really more to do with the government, and the banks a really, really good job of surviving the GFC. So I think on a 30-year basis, we're doing just fine. We're just at one of those cyclical lows in trusts at the moment.
Question over there? Hi.
Yes, Mark, Dom Figlamini, LGS Super. If the Productivity Commission gets legs with its recommendation of best in-house 10 top funds, how do you see that affecting the financial services landscape? And in particular, how do you see having that an effect, particularly in the superannuation industry per se?
I haven't read it. I have not read enough about it to understand what they're actually suggesting. So I don't know specifically what's going to happen with that particular regulation. I think the broader argument, which is, are there efficiencies to be gained with fewer hands in the superannuation industry, has to be the case, which is this is a scale business. You can bring costs to deliver down. The bigger guys get the better opportunities. So overall, thematically, do I think the world would be better with fewer funds? I have to say that I do. But I think that if it's a closed shop, then all you will have done is replaced 10 banks with four banks with 10 superannuation funds, which would be absolute catastrophe, because then all the incentives that have sort of unravelled the banks are going to apply in the super industry.
Another question from the audience. Industry super represented innovation in managing workers' retirement savings. Can this innovation be replicated to manage workers' investments outside of super?
Well, I think people are trying at the moment. I mean, because so much of super is now a tech business, what we're seeing all the time is somebody, leave aside the whole, who's doing what and the agency issues and how the industry's going to happen. But we see fintech deal after fintech deal where people are trying to find a way to have a low frictional cost ability to deliver back to a client. Here's what your house looks like. Here's what your non-super investments look like. Here's how super works overall. So I think there's a fintech solution to that, and I certainly think, because I probably see somebody a month about their money overall, and that's the thing I first do, which is they're always coming back and saying, well, I've got $500,000 and I need to think about how to invest it in alternates. I'm like, hold on, start with the fact that 90% of your overall economic outcome is going to be asset allocation, and you're likely to have 60% of your asset allocation in your home. So you're starting at the wrong place when you want to talk to me about should I put money into this private equity fund or that venture capital fund. You've got to look at it overall. And that, as I say to you, is back to the problem we have at the moment, which is Australia has only the old people with the money, and the old people are massively overweight real estate, and if we do anything to help the young people with real estate, the old people are then going to start running off and vote the Tories back in, and round we go.
I'm going to end on one last question. What's your advice to the investment professionals and directors in this room? Any final words?
Get together, put the TEPEX through the agriculture and find some way to collectively address those issues. You make shitloads of money for the people whose interests you represent, and you'll make Australia a way better place.
And you can get to go over lunch, because lunch is coming up next. Please put your hands together for Mark Carnegie.